Everyone thinks their money is safe because it isn't in a bank, because it's in a big bank, because it's regulated, because it's in a stable country. But what if the idea of banking safety is mostly an illusion? Well, I'm Matteo Maglia, Partnership Manager at GloboBanks, the banking introduction company for international accounts. Today, I want to talk about something that almost nobody questions, the illusion of banking safety. Let's start with the most common belief. If my money is in a bank, it's mine. That sounds obvious, but legally, in most traditional current accounts, once you deposit money into a bank, those funds are no longer technically sitting in a vault with your name on them. They become a liability of the bank. You are an unsecured creditor. That means the bank owes you money. Now, most of the time, that's fine. Banks operate normally. You can withdraw, transfer, invest, but in moments of stress, the structure becomes very clear. We have seen banks fail before. We have seen liquidity crises. We have seen emergency measures, and we have seen deposits limits, or also we have seen situations where governments step in, but not always fast enough and not always fully. Most countries insure deposits only up to a certain amount, 100k, 200k. It depends on the jurisdiction. Above that, you are exposed. That's not fear. That's structure. Now, let's move to the second illusion. If it's a famous bank, I'm safer. Big brand names create psychological comfort. You see a global logo, you assume stability, but size does not equal immunity. Large institutions are often more complex, more exposed to derivatives, more interconnected, and more influenced by regulatory pressure. When large banks face problems, the consequences are systemic, and systemic problems trigger systemic responses, which can include emergency measures, restructuring, liquidity constraints, or sudden policy changes. We've seen that before, more than once. Now, let's talk about the third illusion. If I'm compliant, nothing will happen to me. Compliance does not protect you from operational risk. It does not protect you from automated reviews. It does not protect you from internal policy changes. It does not protect you from risk department's decisions. Banks today operate in a hyper-regulated environment. Transaction monitoring is aggressive. Cross-border reporting is automatic. Correspondent banking relationships are fragile. And when risk departments decide to reduce exposure, accounts get closed. Something without warning, something without detailed explanation. This is not personal, it's policy. And policy changes faster during periods of economic stress. Now, here is the bigger picture. The global financial system in 2026 is not the same as it was 20 years ago. Debt levels are higher, regulation is tighter, data sharing is broader, geopolitical fragmentation is stronger. Banks are under pressure from regulators, from central banks, from compliance frameworks, from correspondent institutions. And when pressure increases, banks de-risk. De-risking means reducing clients that look complex, reducing cross-border exposure, reducing crypto exposure, reducing industries considered sensitive, reducing jurisdictions considered risky. And if your structure is international or sophisticated or simply misunderstood, you can become part of the reduction, even if you did nothing wrong. That is the reality of modern banking. Now, let's go a little deeper. There is another illusion. If my country is stable, my banking system is stable. Political stability does not equal financial flexibility. Even developed economies have introduced capital controls, temporary withdrawal limits, liquidity management tools, emergency banking holidays, enhanced reporting frameworks. And once introduced, these measures rarely disappear completely. They evolve, they expand, they normalize, and most people only realize this when something affects them directly. Here is the uncomfortable truth. Banking safety is not about emotion. It's about structure. It's about jurisdiction. It's about how the bank is capitalized. It's about liquidity ratios. It's about exposure to domestic lending markets. It's about how conservative their risk profile is. It's about correspondent relationships. It's about regulatory climate. It's about also diversification, because through safety in 2026, does not come from one bank. It does not come from one country, and it definitely does not come from brand recognition. It comes from intelligent positioning. Serious entrepreneurs understand this very, very well. High net worth individuals understand this. Institutional investors understand this. They don't rely on a single institution. They don't centralize all liquidity in one jurisdiction. They separate operational funds from reserve funds. They diversify banking relationships. They evaluate counterparty risks. They understand how accounts are structured legally. They understand where their money actually sits. They ask better questions. Most people don't. Most people assume. And assumptions are comfortable until they are tested. Now, let me be very clear. I'm not saying banks are unsafe. I'm not saying collapse is coming tomorrow. I'm not saying the idea of automatic safety is outdated. The world has changed. The financial system has evolved. Transparency is higher. Control is stronger. Coordination between regulators is tighter, and volatility is no longer rare, is cyclical. So the real question becomes, are you structured for stability, or are you relying on hope? Hope that your bank never changes internal policy. Hope that your country never introduces emergency measures. Hope that compliance never flags your activity. Hope that nothing ever forces you to move quickly, because when speed becomes necessary, preparation determines outcome. In 2026, banking strategy is no longer optional for serious individuals. It is part of risk management. It is part of asset protection, of financial intelligence. The illusion of safety comes from familiarity. The reality of safety comes from diversification, jurisdictional awareness, and structural planning. If you operate international, if you hold significant liquidity, if your business crosses borders, then your banking structure should reflect that reality. Not yesterday's reality, today's. Because the people who suffer most during financial stress are not the reckless ones. They are the unprepared ones. And the difference between illusion and security is understanding how the system actually works.